All right, guys, let's get started here. Looking into the first chapter, this is a revision series of all the topics that we will eventually cover and that are part of the syllabus. So let's look into all those topics and in a quick summarized revision format, and then we'll look to solve the exam kit as well along with this. With that agenda for this particular session, let's get started with the revision of chapter one. So we are looking into the summary of the first chapter. So the summary of the first chapter basically starts with us understanding. So it is basically the nature and purpose of financial management. This is the first chapter. Financial management is basically nothing but you acquire money and then you deploy money in both short-term and long-term financial resources. The uh, management, two important words, the acquisition and the deployment. Deployment is like management, is like allocation. So the acquisition and deployment of both short-term and long-term financial resources, which is money. Okay, so what you're doing is you're allocating short-term and long-term financial resources and anything related to getting them, raising them, either take it from the bank, from the shareholders, from lenders, getting it and then deploying it, getting it, deploying it, getting it, deploying it for both short-term and for long-term financial resources. Okay, getting it, deploying it, getting it, deploying it, getting it and deploying it, right? Acquiring it, deploying it, acquiring it, deploying it for both short-term and long-term financial resources. Okay, for both short-term and long-term financial resources. So an entity can or an enterprise can achieve its objective. Why? So that an entity or an enterprise can achieve its objective. That's what financial management. Okay, so it's basically the efficient acquisition deployment of short-term, long-term financial resources. The three important decisions that a financial manager makes. One is an investment decision, where to invest money, right? How to raise the money and how much to give away. If we make profits, how much to give away. Three decisions: investment decision, financing decision, and dividend decisions. So key consideration in every decision. So you have to make sure that you're focusing on three, you're keeping in mind the objectives of the business, the economic environment of the country or the economy in which you're working, and also the risk appetite of the organization. Considering these three things, you have to make all the decisions. Don't make the decision just as it is. You have to look into these three things to make the decision. First, we look into the investment decision. Here is about investment appraisal. That before doing a project, you assess whether project is good for you or not. The in returns of the project, the requirements of the project, does it match the risk return profile that you as an organization are looking to subscribe to? Next, you look into working capital management and investment appraisal. That how do you manage current assets and current liabilities, and how do you fund your working cycle, at your cash conversion cycle? How do you fund it, right? How do you fund it? Okay, so this is about the investment decision. So two things about investment decision, right? So first we understood that there are three key decisions that a manager takes: investing, financing, and dividend. And what is financial management to start off is the acquisition deployment of both short-term, long-term resources. Key considerations you have to keep in mind before making any decision is the commercial objectives, the economic environment, and the risk assessment. Along with that, the investment decision, the investment appraisal. First thing that you look into is the investment appraisal. What is investment appraisal? It is long-term strategic planning. Right. So here what you do is you assess a project before investing in it, whether it's good for your company or not. Then you have working capital management. In case of working capital management, what do? You consider how you're going to manage current assets and current liabilities. We figured out what is investment appraisal and we understood what is working capital management. Next is the financing decision. Okay, so there are three decisions which are very important. In case of financing decision, you have three sources how you can raise money. Either you can take a loan, either you can issue shares, or you can use your company's retained earnings. Okay, either you can take a loan, either you can issue some shares, or you can use your company's retained earnings. Okay, so these are three ways you can raise money. Okay, first thing we understood, there are two types of decisions. One is investment appraisal and one is working capital management. These are the two types of decisions: investment appraisal and working capital management. Then there is three for the financing decision: debt financing, equity financing, and internal sources. Either you use loan, either you use shares, or you look to use your own retained earnings. Next, we have dividend decisions, right? So this is basically from whatever profit you make as a company, how much are you going to give back? You can pay higher dividends, you can retain more earnings, or you can have a balanced approach, right? You can have a balanced approach. One is you can pay higher dividends. It satisfies income-seeking shareholders, but it reduces the funds for growth. Second, you can retain more earnings. Funds expansion may disappoint income-focused investors. Funds expansion may disappoint income-focused investors. Next, balanced approach. Moderate payout while retaining funds for strategic investment. Moderate payout while retaining funds for strategic investment. Okay. So moderate payout. Balanced approach is moderate payout. Retain more earnings is that funds expansion may disappoint income-focused investors, and then pay higher dividends. It satisfies some income-seeking shareholders, but reduces funds for growth. It satisfies some income-seeking shareholders, but it reduces funds for growth. Okay, it satisfied some income-seeking shareholders, but it reduces funds for growth. Retain more earnings. The fund's expansion may disappoint income-focused investors. Income-focused investors may be disappointed. And then moderate payout while retaining funds for strategic investment. Next is moderate payout. All right, while retaining funds for strategic investment, there can be some moderate payouts as well. Okay, there can be some moderate payout while retaining funds for strategic investments. Moderate payout. Okay, so satisfies income-seeking shareholders, funds expansion, moderate payout. Right, balanced approach is moderate payout. Retain is basically you try to save more money because you want to invest in opportunities, higher dividends, so that you can satisfy the income-seeking shareholders. Next, management accounting, it is basically internal accounting. Financial accounting is external accounting. And financial management is allocation and raising of short-term and long-term financial resources. Right? The acquisition and the allocation of short-term and long-term financial resources. That is financial management. External accounting, it's called as financial accounting. It's mainly you make financial statements for external stakeholders. Management accounting is you make the same for internal stakeholders. Next, we have corporate strategy and financial objectives. Here you look into the mission. Mission is the reason why the organization exists. Right? Then you have some goals. Missions are broken down into goals. Goals are broken down into objectives. Objectives are broken down into targets. Targets are broken down into implementation. Almost all business strategies carry financial implications that the financial manager helps deliver. Almost all the business strategies carry financial implications that the financial manager helps and deliver. Okay. Shareholder wealth maximization. See, the primary objective will always be shareholder wealth maximization, right? For the financial objective of the primary objective of financial management. So whenever we talk about financial management, right, the primary objective will always be shareholder wealth maximization. Right? The primary objective will always be shareholder wealth maximization. The primary objective will always be shareholder wealth maximization. And during the mission and purpose, corporate goals, commercial and financial objectives. That primary objective will always be shareholder wealth maximization. Why profit maximization falls short? Right? Long run versus short run. So if you cut training, advertising, maintenance, and also what happens is in the short term, your profit will be very good. Right? Because you would have cut all this. But in the long term, your business will suffer. Okay. In the long run, your business will suffer. If you don't do training, advertising, maintenance, short-term profits will get boosted. But long term, there will be a problem. Quality of earnings. If you have too much profit but too less cash flow, then your earnings are not of high quality. Your profit is a lot. You're earning a lot of profit, but your cash flow is very less. Liquid cash is very less. Then what happens is, in those cases, you will see that the quality of your earnings are not very good. And then cash flow is most important because you might have crores of rupees profit. If you don't have the cash flow to pay your bills, how will your business operate? Right? Accounting profit is a paper figure. Dividends need actual cash. So investors weigh cash alongside profit. Right? As an investor, you need cash and profit alongside. Right? You weigh cash alongside profit. As investors, what do? You weigh cash alongside profit. Okay. As investor, what do? You weigh cash alongside profit. Cash is also important. Profit is also important. Okay. The long run versus short run, we understood. The quality of earnings, we got an idea. Along with that, cash flow matters a lot. Right? Along with that, cash flow matters a lot. Okay. The long run versus short run, quality of earnings and cash flow matters. Right? Cash flow matters a lot. Accounting profit is a paper figure. Okay. Then profits are built on excessive risk. Along with that, cutting, training, advertising, maintenance, all this damages your long-term prospect. Markets will usually see through it. That you might short-term make money, but in the long term it will be damaging. And if your quality of earnings is not good, that is again a problem. And then finally, cash flow matters. Accounting profit is a paper figure. Dividends need actual cash. Okay, so cash flow is very important. Just having a lot of paper profit is not enough. Next, we look into is EPS. What is EPS? Earnings per share. So what happens is you start revenue. From revenue, you remove COGS. You get your gross profit. From gross profit, you remove SAD, selling, admin, and distribution expense. You will get operating profit. From operating profit, you subtract interest. You will get profit before tax. From that, you remove your tax. You will get your profit after tax. And from that, what you do is one part of profit after tax you retain, one part of profit after tax you give as dividends. The part that you're giving as dividends, one you can return, one you can give as dividends. Part that you're giving as dividends, that you give it to preference shareholders and you can give it to equity shareholders. The part that you give to equity shareholders, okay, one you can give to preference shareholders, one you can give to equity shareholders. And the part that you're giving to equity shareholders, right? You take that part, right? Whatever is for equity shareholders, 1,000 rupees, whatever, divided by the average number of ordinary shares or equity shares, and that will give your EPS. How do you get your EPS? You start with your revenue minus COGS, gross profit, SAD, selling, admin, distribution. You'll get operating profit. From that, remove your interest, you'll get PBT. From that, you remove your tax, you'll get PAT. From the PAT, some part you will retain, some part you give as dividend. From the dividend, some first you give to preference shareholders, then whatever is left is for equity shareholders. So you take that amount, divide it by the number of ordinary shares, you will get your EPS. Okay, so that is the meaning of EPS. Next, maximizing satisfying. So see, you cannot satisfy everyone's objective. So there's one group of people you try to maximize their objectives. One group of people will just mean to satisfy their objectives. Right? One group of people you try to maximize the objective. The other group of people you look to satisfy the objective. You cannot maximize everyone's objectives. Okay, next is the stakeholder view. There are three types of stakeholders: internal, external, and connected. External, they don't have any relationship with the company. Internal have an employment contract with the company. Connected have a contract with the company. Might not be employment contract, but they have a contract with the company. So customers, suppliers, finance providers, competitors, equity investors, these are somewhere having a relationship with the company through contracts. Internal purely have an employment contract. External again don't have any kind of contractual relationship. Internal have employment contract. Connected have some kind of a business contract. External don't have any contractual relationship with the company, right? So if you see, if there's one company exists, so first of all, for a company to exist, someone would have put money, the shareholders. Then there would be management who works. They all serve the customer, right? And then there's the government who's waiting for tax. And along with that, there is suppliers, there are lender providers. Okay. So all these people who are interested in the company's existence, all these people are called as stakeholders. All these people who care about the company's existence are called as stakeholders. Right? And all these people who care that the company exists are called as stakeholders. Okay. Next, we'll look into agency theory and governance. What about agency theory? So, agency theory basically means that principal hires somebody, which is an agent, to act on the behalf of the principal. But what happens is a problem happens where the agent start acting on his own interest, not on the principal's interest, but on his own interest. Now that is called as an agency problem. And the solution to agency problem is the framework called as corporate governance. So corporate governance is a solution to the agency problem. What is the problem? The principal hired the agent to act on his behalf. What the agent started doing, it started acting on the behalf of the what the agent did, it started acting on the behalf of the parent. Okay. What did the agent do? The agent started acting on the behalf of the parent. Okay. What did the agent do? It started acting on behalf of the parent. Okay. What did the agent do? It started acting on behalf of the parent, which it should have acted, but it starts acting on its own interest. And that's called agency problems. And a solution to agency problem is corporate governance. Okay. So why was it needed excessive remuneration? Directors started paying them large money despite the company was making losses. Right? They just wanted to make the company as big as possible. They did not really care about whether it making money. They started window dressing. At the year end, they make the financial statements very pretty. Right? They did not want a good company to take them over, even though it was good for them because they feared their jobs will be lost. And they started doing unethical activities. The directors started doing all of this. The directors, the directors started doing all of this. And when the directors started doing all of this, okay, and when the directors started doing all of this, then that was a problem. Okay, when the director started doing all of this, then the problem started to happen. Okay, when the director started doing all of this, then problems started to happen. Okay, when director started doing all of this, then the problem started to happen. Okay, so when the director started doing all of these, then the problem started to happen. Okay, what did the directors do? The director started doing all of these activities, and then the problem started to happen. Because the director is doing all these activities, that is when the problem started to happen. And hence we needed corporate governance. These are all the name of some big scandals that took place. And because of this, corporate governance started really coming into picture. These were all the scandals that took place, all the scams that took place over the years. And because of this, we realized we need some corporate governance. Right? So a corporate governance code started coming as a response to all these frauds that happened. As a response, these are some corporate governance regulations that came in place. What were the regulations? That firstly, chairman and CEO cannot be the same people. Okay, and there should be a complete transparency in the way the the application of corporate governance is done and all the other accounting policies. Either you comply with what is being said, or you explain why you did not comply. Along that, the role of NEDs were given a boost. Right, NEDs really started bursting onto the scene. The need of non-executive directors, directors who don't have any executive responsibilities in the company. They just come, they look into the work of the executive directors, they comment and they leave. Right, they just give a very strong, transparent view because they don't have any interest with the company. So the NED culture has really helped. And it was realized that one way of controlling the situation is paying directors based on the company's growth. If the directors also grew when the company grew, they would be interested in growing the company. If the directors also grew when the company grew, they would actually be interested in growing their company. Okay, if the directors also grew when the companies grew, they would actually be interested in growing their company. They wouldn't have a problem, right? They wouldn't think it's uh, either them or the company, right? They can also grow when the company grows. So they will start acting on more of the company's point of benefit. Okay. Along with that, ratio analysis is something that is very useful in tracking the objectives. You set a goal and your team is moving towards that goal. So in moving towards that goal, a very big benefit is of the ratios. It helps us to measure your progress. What does it do? It helps to measure the progress. Next, we have not-for-profit organizations. Not-for-profit aim to benefit specific groups or society rather than maximize the profit. They look to benefit specific groups rather than maximize the profit. Right? Not-for-profit don't really run a company for profits. Non-for-profit don't really run a company for profits. They run it to support a certain specific group of people. Okay. That's why setting objectives in a not-for-profit is even more difficult. Right. So first of all, quantifying impact. Objectives such as quality of care are hard to express financially. Right. Objectives such as quality of care are very hard to express financially. Second, conflicting priorities. Balancing quality of support against the number of beneficiaries reached. Right. It's very difficult to measure the quality of support. Like how many people did they get benefit from your support? Right. How many people really got a benefit? Right? And distinguish factors. Diverse, it's grant based, long planning horizons, government influence is also there. That's why NFPs cannot be not for profits, cannot be really treated at par with the for profit organization. Both of them are very different from each other. Right? So, how do you do a assessment of the performance of an NFP? You look something into a value for money framework, wherein you look into three things: were the input purchased at the best possible price? Whether when you were converting from input to output, there was zero wastage. And finally, effectiveness. In case of effectiveness, what happened is that your output, did it meet the objective? You did ACCA to get the job. So you got the output. Did you meet the objective? That is called as EEE, economy, efficiency, and effectiveness. Okay, that is called as triple E, economy, efficiency, and effectiveness. Economy is did your input of the best quality. Efficiency, did your input go to the output? When we converted the input to output, when you converted the input to the output, there was zero wastage. Then there is effectiveness. Did your output meet your objective? Did your output meet your objective? That is effectiveness. Did your output meet your objective? That is effectiveness. Next, NFP financial objectives. First one is maximize the funds raised. First thing is maximize the funds that you're raising. Right? Whatever money you have raised, try to maximize, use everything, and have zero wastage. Optimize fund utilization. Maximize how much you can raise. Once you've raised, ensure there is no wastage. Okay. Once you've raised, ensure there is no wastage. Okay. Once you have raised, ensure there is no wastage. So that is all about the summary of our chapter 1.